fact, go to his view real quick. But no, this weird one that I have, camera 3.
It's a good view.
Yeah.
Way. Okay.
Okay, JC, I am ready when you are.
Alrighty. Okay. Key Factors Podcast. Here we go in 3, 2, 1.
And welcome back to another episode of Key Factors Podcast Real Estate AF, where the AF stands for And Finance. And I'm your host, Mark Jones, and we are powered by ReviewMyMortgage.com, the largest index of mortgage programs in the nation. And on the previous episodes, guys, we've been talking a lot about business planning. We talked about potential projections for 2025 and giving you guys some true experts in our industry. Well, today, I wanted to kind of go by that old phrase that you've heard more times than not. There are two things in this world that are inevitable. One is death. The other is paying taxes. And for this discussion, I brought along my personal CPA. So without further ado, I'd like to introduce Brad Dower. Brad, how are you?
Good. How are you doing?
Doing well, man. Doing well. So first time on a podcast, yeah?
Second.
Okay, good. So I'm not breaking you in, but we are going to have a pretty in-depth discussion about some of the nuances that come along with having to pay taxes, both from a buyer's perspective, homeowner's perspective, realtor's perspective, entrepreneur's perspective. And there's plenty that we can go into. But before we do, I want to give you a moment to kind of tell our audience who you are, where you came from, why you got into the business going this route. So if you could, tell us a little bit about yourself.
Okay. Yeah. So I took a non-traditional route into becoming a CPA. I joined the Marine Corps after failing at college the first time around.
Simplify. No, I hear you. Yep.
So I had to grow up a little bit, which the Marine Corps did that very well. Ended up getting married and then went back, got into accounting, and it really made sense. Went back to college. I really enjoyed it. And then, of course, the more I learned about taxes and being a CPA and everything, I got tired of cranking out 80-hour weeks and the boss getting rich. So I started my own firm, right?
Yeah. What is that phrase? The boss comes in, you see the Lamborghini, and he says, if you do well and work really hard, next year I'll get another one.
That's right. Yeah. And so, I started my firm. And as I had grown up through, I got an email from a managing partner who was at a larger firm that said, hey, we know everybody's working 80 hours billable, but need you to work more. And so my goal with my firm was really to kind of get some more work-life balance. I mean, as a business owner, we always work a lot.
Right.
But then at the same time, want to be able to spend time with my family. Our motto is go to the kids' ball games, right?
Absolutely.
And so family comes first.
Yeah.
And so trying to break the traditional accounting mold in that. With my firm. And so, and all my employees kind of live a double win, work and life, right? Because
that's the goal.
It's balance. And we were talking earlier, right? It is hard.
It is hard. Yeah. It's something that we want to strive towards. But as we've talked about in previous discussions, I almost believe it's a pipe dream until you deserve it. And what I mean by that is, did you put in the work in the right places for the right amount of time in order to have that so-called balance that we want to say? Because let's face it, the retirement age is increasing, and for some odd reason, the life expectancy is decreasing these days. So we all want that form of balance in some way, shape, or form, but the idea is put in that work. And I can see you're doing that. I can feel you're doing that. A couple of questions for you. I mean, did you grow up here in Texas?
So I grew up in the DFW area.
Okay.
Small town of Bartonville, so kind of near Denton, if you're familiar with
Denton,
it.
Yeah. What is that up there? UNT? No. What is the college that's in Denton?
UNT.
UNT's
okay.
there.
Yeah. Very good. I cannot confirm or deny being in parties there in my college years.
A lot of good bands came out of that area.
Yeah.
Yeah. Eli Young Band, Bowling for Soup, Deep Blue Something.
And ladies and gentlemen, that is our co-host, co-anchor, producer behind the scenes, JC. So if you can throw yourself up on the screen real quick, JC, so we can let everybody know. Happy birthday to JC. Happy 48th birthday to the man behind the curtain.
Thanks, man. I feel it.
Happy birthday.
Yeah.
Thank y'all. Carry on.
So, Brad, with the idea of you not necessarily thinking that you were going down the road of accounting, becoming a CPA, all that good stuff, what were your intentions? I mean, were you a wild child? What was the path that you were going through that led you to going through the Marine Corps and everything else?
So I had a great time in college, my first time around.
Okay.
Sounds like you did too.
Yeah.
I went to A&M and they asked me not to come back for a second year, right?
Okay.
And so I had a little bit of soul searching. I got
That
into
sounds so familiar. I was at McMurray and Abilene.
it. So, I got married super young and was basically a full charge bookkeeper at a construction company.
Okay.
And I was like, I was 22 and I'm like, am I really maxed out in my salary and everything? And terrible marriage at the time, get married young. We all changed. Right?
Absolutely. Yeah.
So, and it's like, well, I always wanted to join the Marine Corps. And the reason I didn't join the Marine Corps out of high school was because of who was my wife at the time.
Sure.
Women make you do crazy things, right?
Oh my gosh, yes. But all the while, isn't it that they're the ones that are crazy? Wait a minute. I didn't say that. Fast forward.
Is there there's not, this isn't live radio where I can hit a dump button.
Yeah, right. Wah, wah, wah.
So it's just a passion and what I always wanted to do. And so I basically told my wife, who's my ex-wife now, that I was
Oh my gosh, pause. I am so glad you said that because leading up to it, I was like, holy shit, I hope that your wife is not going to watch this talking about her like that.
My wife is amazing. She's the brains behind all the operations.
Love it.
She has the hard job with our two boys. Trying to raise two boys is a challenge at best during most days. I tell everybody we have nothing nice because it's not our boys destroying it. It's our two large dogs that are 100, 150 pounds. Boys have broken TVs and windows, all the horror stories you can think of.
Yeah, it's why you can't have nice things.
That's right. And it's like, should we redo the house? Let's see, the youngest is 11. We got 8 years. Then we can do stuff to the house,
Smart move. Yeah, I have one, and he's rambunctious enough, which is not too far from the tree that he came from, if that makes sense. Ta-da.
Yeah, it makes sense. And so, I just needed to grow up. I think I told my oldest, who's 16, so that's challenging too. And I said, I can't wait till you're 28. And he goes, what do you mean? I said, because then you're going to realize mom and dad were right and you won't be a jerk to us anymore.
That's so true. It's so true.
And so I needed that time from kind of early 20s, or you're just trying to have a great time and figure out life and figure out who you are more than anything.
Absolutely.
Until, so having that family and everything, it definitely brought me back.
Yeah.
But it was difficult, and I wouldn't say I had a great time.
Now, when people, and this is, I'm not going to call it a stigma, but it is a stereotype that when someone mentions CPA or accountant or tax preparer, they all of a sudden think this monotone, clear eyes, dry eyes type of person. And since the first time I met you, that is just not you. And I appreciate that. But how is it that someone like yourself gets along with things like tax laws and accounting, et cetera?
Accounting and taxes just made sense to me.
Okay.
I don't know what it was. It resonated, when you're going through college and stuff. I never had to study for accounting or tax. Of course, I was sort of studying because while I was going to college, I was working full time for a CPA firm. And so I was studying 8 to 10 hours a day, 12 hours a day, right? And so if you want to look at it that way, but it just made sense. I enjoyed it. I enjoy numbers. I enjoy Excel. I know everybody, I'm getting booed now.
No. Yeah. You'd be surprised, man. I think as technology progresses and time evolves, people are getting more acquainted with the idea of what Excel can actually do for them if they create the correct formulas in their spreadsheets, et cetera. It saves you tons of time. I'm not a mad scientist with that as I am like with coding or building websites just yet, but I know it's a necessary evil that is kind of fun seeing it actually work when you put the right equations into the system. And then you mentioned something else about it making sense. Like I always say, if it makes sense, find a way to make dollars out of it, right? Because they all add up. So there was a poll of about 1,000 people that were asked what the first thing that they think of when they think of taxes. And it says most people viewed taxes as necessary, but often frustrating part of life. And it gives us the other frequent answers that they give, starting with the negative. It says they view them as a burden. The complexity of them is too great. The lack of transparency in knowing what you're actually doing. And the last negative is unfair. And then it goes into the positive ones: necessary for society, civic responsibility, and progressive system approaches leading to potential gains. Then the mixed feelings are definitely desire for reform and reluctant to accept the changes. You being on the other side, the other seat, would you agree with some or most of those statements?
Probably none of them.
Okay, and why?
The big one, to me, it's not your civic duty it's your civic duty to pay taxes. However, it's your civic duty to pay the least amount possible. And so tax law there's 20 to 30 pages in the tax code on how to collect a tax. The thousands upon thousands of other pages are how not to pay tax. So you have to change your mindset on what the taxes are. The government is trying to incentivize behavior, and that is really what taxes are designed to do, is incentivize behavior. If you can be a business owner and have employees, you're going to get tax breaks. If you're going to be in real estate, you're going to get tax breaks. Real estate is one of the single graded asset classes to never pay tax again in your life if you do it properly. Wherever you stand politically, Trump, he makes millions of dollars and they release his taxes and he paid $100 in taxes. My question was, why do you pay $100? And he's a better tax advisor. Of course, I don't want to be the tax advisor because his tax advisor went to jail. I'm not going to commit fraud, but at the same time, he's in real estate, right? And
Absolutely.
so it's the single greatest way to never pay tax again in your life if you do it properly.
And that's a great way to open up this discussion. I don't like to get political on here, and our goal is not to be political in whatsoever in this, but that is a good point that you bring to the table. The idea that the person that is creating jobs, creating opportunities, employing others, changing what little that they actually can do within the world that they operate in, and now a much bigger world if we're talking about the same person, should get some tax breaks. And when I hear the other side of the coin saying, well, they should be paying more, well, they didn't get there by being greedy. There's no way to build a business by yourself. There are others that are necessary in order to establish a business, to grow a business, to operate a business. And I think the level at which, or the magnitude at which your business grows, the more benefits you should get as the person that took those risks, the person that took those sacrifices in order to do so. And I love the fact that you said people need to change their mindset, especially those. Now, mind you, our audience is mostly realtors, lenders, entrepreneurs. We all have this kind of mindset because we're in this seat on the bus. But for the folks that are listening that are W-2 employee, this is giving you a glimpse into the minds of not only how we think, but how we act. Because it is all stem from a good place and providing more possibilities and opportunities for many, but there would be very little incentive to continue to do that if there was not some type of relief for the people that could get it done, if that makes sense.
It makes sense. Yeah, I mean, I learned when I started a business, you have your time, your money, other people's time, and other people's money.
Yeah.
And yours is a limited resource and everybody else is unlimited. So as you can start a business, the bank's going to give you money if you have a successful business, right? So now your, money is almost unlimited if you do it right. And then start hiring employees. You can work 80, 100-hour weeks. You're going to burn yourself out, right?
That's right.
But now we can get somebody and get a team behind us. It's, business is a team sport.
I like that. Yeah, definitely. Okay. So going into some of these questions here that I'm sure plenty of realtors, home buyers, homeowners want to know. We can start with the idea of, let's address for home buyers first, home buyers versus renting. There's this idea of, especially now when everybody's talking about home affordability. Someone that is renting, and it's simple to say, well, you're throwing away 100% of your money versus paying interest on some of it, et cetera, and then building the equity. What are some additional benefits for someone that is purchasing a home? And we're talking about primary residence only right now.
Okay. Yeah. I mean, it's good and bad right now. They've raised the standard deduction so high, right? So a lot of people's taxes did get simpler. But if you can get, Texas, our property taxes are ridiculous.
Yeah.
That's
true.
And so you can deduct your property taxes, right? And your mortgage interest are kind of your big ones.
Correct.
And so and everybody's mortgages now are a lot higher than they used to be. My first house was $120,000, right? 3-2, two-car garage. And now the same house is like $400,000.
Wow.
Yeah.
Wishing you would have held on to it.
I know, right? It's like, dang it, I should have held on to it. But it's like, at the same time, I had to sell my Amazon stock to buy that house. I held on to that. We probably wouldn't be sitting here today. I'd be sitting on the beach somewhere.
Oh my gosh. What's funny is yesterday I saw a post about Bitcoin. And 2020, I owned a full Bitcoin. Matter of fact, we forgot to put the cost basis, and that's why we ended up where we on my amended returns. But the idea is, if I would have just held on to it, oh my gosh, it would be absolutely. I think it's at $106,000 for one Bitcoin today, something like that.
Something like that. It went over 100,000 over the weekend. I think. Yeah, it was
like whoa. But yeah, you never know, and you can't foresee the future on things like that. But the idea of owning a home is something that a lot of folks tend to shy away from when they're looking at pinching pennies and trying to sustain their current lifestyle. When it comes to those expense write-offs, deductions that you're talking about, are those big game changers, or are they just small gains, or does it depend on what you're doing with other income that make them bigger or less of a benefit?
This is the tax standard answer. It depends, right?
Yeah. You know what? I say the same thing. And it means more so that you're an expert, because you don't give some blanket response to a broad question like that. But go ahead.
Yeah. I mean, so if you can get over the standard deduction, right? So as a married couple, we're roughly around $30,000 now, right?
Okay.
And so that is going to, and your state and local tax is maxed out at $10,000 now. But then, so really mortgage interest. So if you are paying the mortgage interest deductible, but then it gets into your charitable contributions, is kind of the key three things that are going to go into your itemized deductions.
Okay. Repeat that one more time for our listeners. You've got.
So you have your state and local tax, and then which is maxed out at $10,000.
Yep.
And then you have mortgage interest. And then on mortgage interest too, if you have a second home, they can deduct that too. And a second home can be like an RV.
Okay.
Right? So if you have a recreational vehicle, you can consider that your second home. It's kind of one of that gray area tax loophole things.
Okay, gotcha.
And then your charitable contributions is your big third one. You can deduct medical expenses as an itemized deduction. However, it's limited to 7.5% of your income. And so most people, if you're making $100,000 a year, then you have to spend over $7,500 in that example, right? To be able to deduct any kind of medical expense. And that before you see a dollar of medical expense.
I see.
And so unless you have something catastrophic happen, you're really not deducting medical expenses typically.
Yeah. It's more so going to be your taxes, your mortgage insurance, and then your state taxes, which does fall into what type of category when it comes to state part? When you hit the 10K, how can you hit the 10K quicker than not?
I mean, look, down in Texas, right? Property taxes is over 10 grand, typically.
Done.
Yeah, over that. So losing that, if you buy a car, the sales tax is deductible. You do get a standard deduction for sales tax as part of is included in that area as well. And so any kind of large purchases for sales tax, you can kind of claim that in extra on top of your standard sales tax deduction.
And I think that's the one thing, and we'll get into this a little bit later. One of the reasons why you have realtors that buy new cars each year to write off on their taxes, but we'll get into that in a little bit later in the discussion. So that is the personal side of being a homeowner. It's going to help you on your taxes, and us mortgage professionals and realtors say it quite often, but it doesn't sound like it's going to be a whopping savings for them that's going to change how they're living based on what they purchase. So as we lean into the next category, the investor side of things, how Can you help us understand some of the deductions, some of the ways of paying less taxes, bottom line, when you're an investor?
Sure. Let's go back to the individual side real
Sure,
quick, because
go for it.
there's a bunch of tax credits for energy efficient homes, putting new doors, windows, solar panels. It's like, definitely don't overlook those, because
Okay.
clients all the time, when they put new windows in their house, they totally forget about it. But pretty much every window that comes out now is Energy Star certified,
Yeah,
right?
that's right.
And so
Has
they
to be.
have the double pane with the gas in between them and all that. So like, don't forget about those. Is it only going to save you a couple $100? But hey, I would say take the family to Disney World instead of paying Uncle Sam.
Boom. I like that. No, that's
So-
a great way to look at it. Absolutely.
And then back on the investor side, it really depends. So as we know, real estate is like this giant gamut. You can do everything from syndicating real estate deals to having single family home, commercial real estate. You can wholesale stuff. I mean, like, it's almost unlimited potential on what you can do in real estate.
Right.
Which is one reason I love it so much. And like I said, real estate's the single greatest way to never pay tax again.
I love it. I love it.
And if you do it properly and have a great strategy, from an investor side, if I was to give you the 30-second clip of how to do it.
Well, you can make it longer. This is long
Okay.
form by all means. Yeah. I want to make sure that the folks out there know that I'm working with a badass, bottom line. So yeah, go for it.
Yeah, I mean, it's from an investor standpoint, and on the individual side too, a little bit, is you can do what's called the short-term rental loophole, right?
Okay.
And so that there's two buckets for tax purposes of income. As far as when we're looking at real estate, you have passive and active income.
Mm-hmm.
So passive income is typically going to be your real estate income, right?
Right.
And then your active income is like your W-2 wages. And so typically you can't offset your active income from your W-2 against passive losses. And real estate is tax advantage, which I'm sure we'll dive in more here due to depreciation and some other stuff.
Correct.
And so you typically have a loss on tax purposes for real estate. But then you have a cash flow positive asset. So you get to basically have income and not pay tax on it, which is what we all want.
That's right.
And so the quick way to do that is, if you want to get a property, is to start with a short-term rental, and you can use arbitrage and go do the whole Airbnb thing. I mean, there's all kinds of different options.
Sure.
Right? But you can, the key to that is you have to keep the average stay under 7 days.
Okay.
And once your average stay is under 7 days, you're basically quote unquote operating a hotel.
Right.
And then, so that's an active business under the IRS viewpoint. And it's not that you can have like a month-long stay if somebody stays in your short-term rental.
Right.
But then you've got to make sure that you have somebody go in there for a weekend, and so you can get that
A
average
gap
stay.
in between.
Yeah, get your average stay throughout the whole year under that 7-day mark. And that's kind of the big thing that clients miss on that one. But then you can go and do advanced strategies on top of it. Is you can go do a cost segregation study, which is what the government wants you to do. But that's where you basically separate out what they call the units of property on a building. And so it's everything from your flooring to your cabinets to your HVAC to plumbing. You can get a cost segregation study done on your building. And when we had 100% bonus depreciation, which I hope they'll bring back, they've had a bipartisan bill in Congress for over a year to bring back 100% bonus depreciation. Right now we're at 60%. So the value is not quite as big, but it's
Sure.
still better. And if you basically take your property, so on a standard residential property, you're at 27 and a half years. On a commercial property, you're at 39 years for depreciation. And that's how long you have to take basically the cost and divide it over that, right?
Right.
And
To determine the depreciation.
For the year. And so, but you can typically go and get around 20 to 30% of that total purchase price as a deduction in year one if you do a cost segregation study.
Wow. And I don't think many folks know that. Matter of fact, one of the issues, and this is side note, potentially rabbit hole, one of the issues that I see with many first-time investors, even second-time investors, is they're not claiming their properties on their tax return. They either forgot or they think that it is a benefit to not put it on there so that they don't know that you're making the money. But then they realize that, hey, if you go to buy another one and you haven't actually claimed this on your taxes, you technically are still a first-time investor. So all of the first-time investor requirements are issued on that type of condition. And it causes a lot of issues when it comes to purchasing more properties, continuing to grow your portfolio and your wealth. Do you see that quite often from the folks that you work with?
If first time, yeah, they forget depreciation or they calculate it wrong. And if you get audited by the IRS, something to know about depreciation, it's the depreciation that was allowed or allowable. And so if you miss the deduction, whenever you sell that property, you're supposed to report the deduction even though you didn't take it. So you're losing money.
Ooh,
And so
it's a double loss.
Double loss. So hopefully you don't get audited, right? But if you do get audited, and that's pretty low hanging fruit for an IRS auditor,
Sure.
To figure out like, oh, you didn't take this deduction, too bad. But now you have to, and so then you're taxed higher on depreciation recapture, anyways. And so you definitely want to make sure you're taking all your depreciation on your buildings.
Yeah, see, and that's just one thing that I've seen happen over and over, especially as rates increase. We saw the qualifications for investors decrease. So they're going off script to purchase either hard money or they're going non-QM type products. And then the year passes and they come and say, hey, time to buy another one. Oh, I didn't claim that one on my taxes. Well, we can't offset it. I've got to hit you with that mortgage payment completely. Oh, I can't qualify for another one? No, you don't, because we've got nothing to offset it. And I think it's something that could be resolved by people educating themselves a little bit more and understanding the idea of what you're actually doing. And you said it best at the beginning. You're finding ways legally to pay less taxes for your hard work and risks that you're taking, essentially. So continuing down the road of the investor pool, and this is an odd question, but I'm going to ask, if you were to paint a perfect picture of, and I don't know, maybe this is stuff that you dream about at night as a CPA, as an investor, as a entrepreneur myself, these are some of the dreams that I have. What would it look like for a perfect scenario of someone that is attempting to build an empire, so to speak, starting with one? What does that look like as it grows, if you don't mind me asking or going through that? Paint me the picture. Paint me a Birmingham.
What about some oceanfront property?
Hey, as long as we're not in Arizona.
Yeah.
Go for it.
Yeah, so starting kind of the beginning in the real estate world, it can be tough. I mean, we were talking earlier, there's a ton of different avenues to get in.
Right.
I steer away from residential property, so all the realtors are probably going, "Oh no!" But
no, I've got commercial realtors on here. I've got brokers. No, not at all.
And the single fact is that most commercial leases are triple net now, right? If I go to a residential tenant and say, "Hey, I'm raising your rent $100 a month," they're going to freak out and be like, "We're just going to move." And then you got turnover, and then you've got to go out and repaint it potentially and fix whatever they fix. But in a commercial space, if your property taxes go up, which they anywhere around the country, property taxes are skyrocketing.
Yeah.
It just gets passed through to the tenant.
That's right.
And you got a business in there, and the business to keep going is going to make sure they pay their rent typically. And then, if you have a residential tenant that's not paying their rent, to evict them is it's like a 3 to 6 month long process, right?
Absolutely. Yeah. Even to just get that notice to them. You're right.
And
if it's their primary, it could even take longer.
And on the commercial side, you don't pay your rent, I can go lock your door.
Yeah, that's right.
And so you're, as a landlord and an investor, you're a lot more protected on the commercial side. And then, I mean, you may not make as much, especially if you're going to go in and flip the home and redo it and that kind of stuff. But there's the BRRRR strategy on the residential side, which is great. Then
it is when you can find the right properties, the right trades to work on that property to flip, the right hard money lenders that have the right terms.
It's a lot of work to get into it and to do
right.
it right. And that alone, and all of this, record keeping is key. Having a good accounting system in place that isn't burdensome. Or if you're like, hey, I'm not great at accounting, go find an accountant to do it for you. And you can get bookkeepers pretty cheap these days, but I will say there are a lot of terrible bookkeepers out there.
Yeah.
And so be careful. But if you don't need to have this in-depth QuickBooks Online, multi-class, and all this crazy stuff going on. Like if you only have a few transactions a month, you can do a simple Excel spreadsheet.
Okay.
What we recommend to our clients too is every time you've got a receipt, is get Dropbox or OneDrive or something on your home screen on your cell phone, because you can pull up that receipt, take a picture of it, and then you can throw that receipt in the trash. A digital copy counts.
That's right.
For record keeping, and so that is huge. And then for real estate investors or agents, mileage is your number one deduction typically, especially on the residential side. They are probably some of the hardest working people ever. They're driving and they seem to have no personal life. Somebody calls them, hey, I want to go see a house. Okay, be right there. You're like,
You're right. You're right.
They're super hard. Every residential realtor I know is very hardworking, but their mileage log is something they don't do.
That's right.
And if you get, it's the number one, probably not the number one of the number one most overturned expenses on an IRS audit.
Oof.
And so what you want to get is some kind of app like Mile IQ.
Okay.
It's a great one. It's what we recommend for our clients because then it automatically records in your background and everybody's like, oh, I'll write it down and I'll get a logbook. And then, if you've got kids, the kids are yelling and screaming in the back seat or whatever, right? So it doesn't happen, right? So I believe in automating as much as you can.
Yeah, you must have been my CPA for the last couple of years or something. I don't know.
Or just any parent, right? I mean,
right. That's right.
If I can keep my kids to be quiet for 5 minutes sometimes, I'm like, what's
winning?
What are they breaking, actually?
It's true. It's true.
But anytime you can automate any of it, that's really the best you can do. And QuickBooks is kind of the go-to, but at $80 a month, most people probably don't need it.
Sure.
There's other solutions out there that you really want to make sure it connects to a bank feed. And on that note, too, for investors or realtors, when you set up your business, you need a separate business bank account.
Okay.
And then get a separate credit card because that makes your record keeping at the end of the year 100 times easier. Because if you forgot something, be like, oh, flew through this bank account. Like, this is it. Instead of commingling everything. Then especially if you have an LLC, you definitely want to make sure you're not commingling assets because then the liability protection from your LLC is kind of null and void. And any attorney worth anything is not only, no matter, even if you have an LLC in place, is going to sue you and your LLC, right? Because they're going to come after everything. And so, but if you're commingling assets inside your business, then they can come after you personally.
So that leads me to a question about the commingling. I've got a borrower situation that we're having a tough time with, and this is current what's going on right now. They are sole proprietor, Schedule C, have never opened a business account. The only income that they receive is 1099 as a plumber, comes in. That's it. All the money goes into the personal account and all the expenses go out of it. Now, mind you, some are personal expenses, some are business expenses. But from the way that I look at it is if the only money that's going in there is from business funds, should he not be utilizing that concept, or would it not then be considered everything is considered business from that one account? Or is it the other way around to where technically if you don't have a business account, it's all personal, buddy?
Yeah, and it's the burden of proof lies on you, right? If you ever get audited.
Okay.
And so you want to have certain things set up and in place that when you're going through them. And so just having it as simple as a business account, you can just go down to the county and get a DBA. They're like $20, right? At Bear County here. To go get a DBA. And that way you at least have the business, you set up the business bank account, and then you can always take money out. Everybody asks, well, if I take money out of my account, it's taxed. And the answer is no, you get taxed on your profit or loss of your business at the end of the year.
Right.
Not if you can leave $100,000 in your business, but you're still going to be taxing that $100,000. Or if you take it out and you can add money in, it's just a capital contribution or distribution. You're not really taxed on that as long as you have what's called basis, as long as you don't take more money out.
Right.
And you can, if you go get a loan, you can take more money out of your business, right? Then you potentially have, there's a whole slew of tax consequences that happen from that.
Right.
But that's, so there's really keeping that separate business bank account and keeping all your records in place, no matter what you're doing. Whether you're a plumber or you just have you're a realtor or whatever it is, keeping that separate, and it'll help you down the road. Hopefully you never get audited and you never need it, but you'd rather have all the information and be able to provide it.
Absolutely. I agree with that. Now you've mentioned audit probably 15 times thus far. I'm going to ask ChatGPT this question to see if it makes sense. In the United States, how often is someone's taxes audited? Let's see if you agree or disagree with this thing. Overall audit rate. As recent years, less than 0.5% of all tax returns are audited, meaning fewer than 1 out of 200 taxpayers are selected for an audit. The rate has been declining due to the budget cuts and resources limitations of the IRS. So business owners out there going, yeah, let go of all of those people at the IRS. Let it take longer. But then at the same time, when they're waiting for their refund to be processed or anything else, it takes longer for that stuff as well.
And so there's 2 types of audits. So what they're probably keying on here is the actual physical audit where you have somebody come in and actually audit you. Most of your audits are really matching errors. And so you get what's called a CP notice, and that just stands for computer process. So just like we're all instituting AI and everything else behind our businesses to try to make us better. So
Right.
the government's getting there, but at a much slower pace.
Right.
But at a high level, they run everything through a computer. And so if you get and for realtors specifically, like you get a 1099 that says you made $100,000 in income, you report $98,000 in income, and maybe your broker took some of that, so you didn't get it. But then there's a broker fee that you need to report and gross up your income to that 100,000.
Sure.
You need to report the 100, because if you don't report that 100,000, it's just going to be a simple computer, and you'll get a letter from the IRS that says, "Hey, guess what? You've been randomly selected." Not really. The computer randomly selected you,
Right.
And because you didn't match. And so you always want to make sure you're matching anything, any document you get. That your, W-2s are easy. You Bachman wages, put that in,
Sure.
so on and so forth. But really, it's the 1099s, because you may not match, because there is, sometimes the broker gives you the wrong amount,
Right.
or they're taking fees out, or like a lot of clients who use Stripe. Stripe takes their fees out, and you only get the net amount to your account, right? But at the end of the year, Stripe's going to send you, that 3.5%, whatever they're charging, right? They're going to send you for the total gross amount as your 1099. But if in your accounting system you only recorded the net amount because that's what came into your bank account, then you're going to get a matching notice.
That makes
sense.
sense.
Because you get the 1099K, which is for all your credit card transactions, right?
Yeah.
And so that's kind of a big red flag, and that it's easy to fix, right? And it's your tax situation is not going to change, because we add income, but then we add expense, so it nets out to zero.
Sure.
But as far as making sure you're doing what's right and not going to trigger their computer, that's really what we're trying to do.
In addition to the lost time that you have from receiving that notice and going, oh shit.
Yeah, open the envelope and everybody freaks out, but half the time, like especially if you have a business, it's like, hey, we updated your address, or it's like something, or like, hey, if you have employees, they send out, hey, your deposit schedule is this. Like, don't ignore it. Like
That's right.
Open it up, and hopefully it's nothing. I mean, it could be more, but
Right.
We got another one. Oh, it's okay.
yeah, don't just take it and throw it in the shredder and be like, I never got it. I don't know what happened to it.
Yeah. No.
Oh, they know you got it.
Yeah,
know
because then
you
they're
got
gonna
it.
start sending certified mail to you,
That's
right?
right.
And then they know you got it, and then you can't ignore them anymore.
That is correct.
And as from a CPA standpoint, we can help you a lot more earlier on when you get the letters versus when they say, hey, we're going to levy your assets, because we're kind of, okay, we're going to take them to tax court.
We've done all we can at this point.
Probably not going to take them to tax court, because that's, $20,000, $30,000 to go
Additionally.
get right. So let's just go through this and take care of it. And communicating actively with the IRS is key. If you ever get a notice, you can call them if you can get through, because they'll probably half the time. Half the time you call for an hour and then they just hang up on you. Sorry, we're too busy. Nothing's more frustrating, right?
We've all been there, absolutely.
And so it's just like, it's so frustrating. But at the end of the day, like, if you can call them, they can typically put a 30-day stay on everything, and they give you 30 days. Like, if you can't get everything together, but the sooner you can be in active communication with the IRS, the better.
Yeah. And it's what's funny is you mentioning that is the same philosophy, same concept with real estate when it comes to a single transaction. Get in communication with the parties that are associated with that transaction as soon as possible, so that everybody knows. Everybody assumes that, oh my God, they're going to be upset at me. Maybe, but at least they now have the time to do something about it and to work with you and iron out whatever it is that's going on, versus keeping it close to your chest and thinking things are going to change, because it's not.
Yeah, half of it's just setting clear expectations with both parties, right?
Right. That's exactly correct. So going over some of these next questions here, we've talked about thus far benefits from a buyer's perspective, a homeowner's perspective, both primary residents, in addition to investors out there. Now, obviously, there's way more nuance to all of this. There's no way to go down all of these rabbit holes today. We want to kind of keep it surface level, so it kind of piques the listener's interest. Maybe they give Brad a call here. But the idea of this next piece is for realtors specifically. It has tax strategies for realtors. What are tax strategies should realtors keep in mind, especially those who are self-employed running their own real estate business? And I think you mentioned some of those already, but if you don't mind reiterating, like specifically, what would you recommend for a realtor? Because I know the listeners, we've got first year, second year, all the way to experts that join us on this show listening in.
I think the key phrase there is you said as a business. So
Yeah.
treat it as a business. And
Love that.
and so do all the stuff. So if you've ever been in corporate America, they have all these rules and regulations. The reason they do that 9 times out of 10 is for tax compliance purposes. Like submitting your expense reports and doing all this seems like a pain, but the reason they have to do it
Right.
is because the tax law requires them to do it. So even if you're just a small mom and pop shop or just a single realtor out there, you still fall under the same tax law as corporate America. I mean, I guess it's a little different nuance between all of it, but at the same level, you have to have certain things in place, right? So we talked about record keeping already. It's
Absolutely.
definitely keeping clean records, having that separate business bank account makes it easier. Keeping track of mileage, like we said, for realtors is one of your biggest deductions. So actually get a mileage log, because if you get audited,
Right.
they're going to throw it out. And then now you just lost a $40,000 deduction.
Now, question for you, because I do quite a few loans for realtors out there, and a lot are having to go the bank statement route or non-traditional route because they don't claim all their income year after year after year. And it's not necessarily claim all their income, but their expenses either outweigh what they gained or get very close. So they're not essentially paying taxes, which in many cases, like for me, part of my income's W-2, so it gets taken right away. With them, they've got to tuck away some money, hopefully at least 30% every year for the taxes that are going to be coming due.
It's 30% is a great rule of thumb,
Right.
as far as it. But a lot of them, especially first year agents, they come in and see us, and I'm like, well, you owe $27,000. They're like, I owe what? Yeah. And it's like, remember when you're a W-2 employee and they take out federal income tax? Have you paid any taxes in this year? They're like, no. I'm like, okay. So there's this thing called self-employment tax, right? Yeah. So that's 15.3% is your self-employment. So you not only when you're self-employed, when you're an employee, you only have half of Social Security, Medicare, right? But when you're your own boss, you have the full brunt of both the employer and employee portion, which totals up to 15.3%. So whatever your profit is at the end of the year, you're already paying 15% plus whatever your tax rate is
in the bracket that you fall within.
In your tax bracket, right? And so kind of an all-in a good rule of thumb is 30%. And if you end up with extra money in that account at the end of the year, great. If not, you got to pony some up.
That's right.
But definitely, and don't get into where you have 15 different accounts and, like I have my tax account and then I have my payroll account and then I have my vendor account.
That's right.
Just really, if you can have a business savings and a business checking account, it makes your life a lot simpler, because when you start doing, it's escaping my mind. I forgot what it's called, but there's the whole philosophy of having all the different accounts. And
I see it more often from people that aren't business owners. And it's like, you've got 5 accounts and you call this one, you're this account, you're that account, you're this account. But every month you're pulling from this account and that account and this account to move it to you're making your life a lot more complicated than it needs to be.
Yeah. KISS method. Keep it simple.
There you go. Yeah. KISS method. That's exactly. I do remember that. God, it's been a while since I've heard that. Yeah. I'm like, okay, that's right.
Where did that originate from?
I don't know. Damn sure wasn't taught in schools.
It was, and it's either stupid or shithead at the end of that, right?
Yeah, that's right. That's right.
And depending on who you're talking to,
That's right. Keep it simple, stupid shithead. I like that. I'm adding that from now on. Keep it simple, shithead. You know what I mean. Now the question comes into play when the IRS is seeing this self-employed realtor continue to take losses year after year. Is there a limitation when it comes to the eyes of the IRS that goes, hey, dude, it's been 4 years. At what point are you going to turn a profit so that we can make some money from what you're doing, if that makes sense?
It makes sense. Yeah, there's a 3-year rule for hobby losses.
Okay.
And hobby loss is a higher area of audit than anything. And so you want to be included in that lucky, 0.01% of taxpayers.
Sure.
Have a business that is not reducing its loss or going ahead and having a profit, right? If you have 3 years of losses, like I said, the computer's reviewing everything, right?
Oh, yeah.
And so when you have
just flagged, boom.
It's just flagged, then you'll get the letter that says, hey, you had randomly selected, right?
It's not random at all.
It's not random at all. You did this to yourself.
That's right.
And then, like, if you're trying to get a mortgage, right, if you show losses, so there's ways to show losses and not pay tax, and that's typically going to be through depreciation. Then on the mortgage side, you'll add it back.
That's exactly right.
Right. And so if you're going to go buy a new vehicle, you brought it up earlier, purchasing a new vehicle every year. From a tax standpoint, great. From a personal finance side, not great,
yeah.
right? Because you spent $100,000 to go buy the new latest and greatest F-150 or whatever,
That's
right?
right. Isn't it sad that they're that much?
It is.
Like, what the heck did they add to them? And yeah, you're right.
That's why I'm going backwards. I'm buying a 1948 F1. That's my next truck.
Boom! Beautiful step side. I love it. Okay.
But it's so, yeah, I mean, there's ways to not pay tax, but still do everything. And when you have your own business, there's the gray area of your personal versus non-personal expenses.
Right.
There's ways to tie back, because like your realtors, your cell phone, home office deduction is a great one that, most agents can take. And so then you get a pro rata portion of all your utilities and repairs and maintenance and property taxes and mortgage interest on your business to offset that as well.
Right.
So you get to capture, if you didn't have your own business, which are personal expenses, you don't get any of the tax deduction for.
That's right.
When you have your own business, you do get to start taking some of those.
That makes perfect sense, and also makes sense as to why we see a lot of non-self-employed borrowers that have an Etsy store that is losing money like
I think
crazy.
everyone should have a side hustle or
Yeah,
something, right?
okay.
So because I can write off my cell phone now, and now
That's right.
or a home office. So home office, say you have 1,000 square foot home and 100 square foot office, you can get 10% right of all your home expenses now. That basically, if you didn't have a business, it's just gone, right?
Right. And that leads to another question that hopefully people can get some value out of. And that is the idea of everyone should have a side hustle. What would constitute being able to claim that on the taxes, let's say as a Schedule C, utilizing their social security number as the ITIN number or the EIN number of the business without a DBA or anything like that, before it starts to cause any ripple effect or red flags, random audits?
Yeah, it sounds like a broken record, but record keeping, right?
Yeah.
I mean,
Okay.
because it really gets down to having good records. And so if you're going to have a business and the side hustle, I mean, you need to be doing it for a profit purpose is going to be one of the first things the IRS
That's
will
right.
ask, right? And so are you in this for making a profit? And if you turn up and say no, then you just shot yourself in the foot. But
Yeah.
no,
I just like doing it, keeping track.
yeah, I'm doing it so I can save money on taxes. And it's probably not the best answer, right?
That's right.
And so anytime you go into a business, right, it's typically to make money.
Yeah,
We
absolutely.
hope not to lose money unless you want to go into farm and ranch.
Yeah, touche.
No rancher ever makes money.
Never. It's so funny. But yet they continue to stay in business for years and then pass it down generationally. Weird.
Well, that's how they can, right? Because they didn't have to buy the land. If you had to go buy 1,000 acres now, right?
Good luck.
Good luck, yeah.
That's right. Okay, so we talked about the real estate side of things. We talked about for real estate investors, real estate market impact. Let's see what this says. Impact on interest rates. How do rising or falling interest rates impact tax situations or both for home buyers and real estate investors? And I think I kind of know the answer to that, but if you don't mind shedding light on it, the idea of rising interest rates and how that can impact what both homeowners as primary and business entrepreneurs investing on their side of the tracks. I only see it as a benefit.
I mean, you're paying more, but you get a larger deduction, you know,
Right.
from a tax standpoint. It's more of a personal finance and cash flow issue from an investor or from the personal side, because you get into the debt to income ratios and all that kind
That's
of stuff
exactly
to qualify
right.
for the mortgage.
Yeah. You want to be a loan officer?
Yeah,
That's all on that one. Let's see here. It says controversial topics, short-term rental properties. Ooh, that came up and we talked about it already. How do short-term rental properties like Airbnbs differ from long-term rentals in terms of tax implications? We talked about that earlier. And
it's the
you can
active
reiterate.
versus passive income, right?
Yeah.
And so short-term rentals are considered active income. And so a common mistake we see on taxes is they're still reporting on your Schedule E, which is the typical form that you report it all on, but it
Yep.
should go on a Schedule C.
Makes perfect sense. So that is all the questions that I have here. Now I'd like to open it up to some other things that I have on my brain that I think folks would want to know, especially investors out there, because I tell you, this is probably one of the most, it's either asked prior to, or they're telling me that this is what they did because of a CPA that told them to do this. And that is the concept of, I purchased an investment property with financed from a loan, and my CPA is telling me to put that into an LLC for liability protection. My response to that, and you can tell me if I'm right or wrong, doesn't bother me, I want to learn today. For us, as the lender on that property, if they are putting that into an LLC, that is now essentially triggering a due on right now clause, essentially, because you just removed it from your own personal, which that's who qualified for this property, over to an LLC. That the idea is if there's any liability, I get sued, the LLC gets sued, but yet you've got this personal loan on it that is tied back to you. So my response is always, the good idea is to leave it in your personal name, make sure you have insurance, obviously, but until that property is paid in full, there is no reason to move it over to an LLC. Am I wrong, right, indifferent, kind of wrong? You tell me.
Both. I mean, the problem is when people say they put in their LLC, most of them never actually go retitle it at the county, and so they never really.
Point. Good point.
And so it's still in their individual name, even if they're reporting it under their LLC.
Yep,
and
I've seen that too.
Right, and so if you're going to start purchasing stuff in your LLC, I would say go get a business loan.
That's right.
Because the paperwork is like this big, right, on a business loan. You're
right.
in and out in like 2 minutes. Even it can be a $10 million property, and it's like 10 pages. You're like, oh, this is awesome. Versus you go buy $100,000 residential property. Well, if you can find them anymore at that price, but
that's true. That's true.
But then it's like the pile of paperwork, right? Is like this, and you're like, how many times do I have to sign my name?
That's so true. And personal experience on that, when Kristen and I were flipping the properties, we were buying the houses cash. So essentially, or getting hard money loans on them, we had to put the properties in the name of the LLC, which at the time made sense. And it felt like I had confirmation of everything that I had told borrowers prior to, because it's like, okay, I've got to put this in the LLC. That makes perfect sense. But with these folks out there, I feel like they want to feel like they're doing it the right way, or feel like they are more established, and causing more hurdles down the road for them, either from the lender, the CPA side, or is it many cases the inexperience of the CPA that's advising them, or them just trying to make a couple bucks off of claiming more work on the taxes, filing for the DBA, et cetera, whatever the case, the LLC, and there's a charge to register your DBA and all that jazz. What are your thoughts on that?
I think as you get bigger and have more properties, maybe you set up some kind of LLC, but if you're going to have one or two properties that may be all you ever get, it goes back to the KISS method. Just keep it simple. And if you're worried about liability protection, go get an umbrella policy, right? You can go get a $2 million umbrella policy. So, I mean, you should have the homeowners insurance and the landlord insurance and all the other insurances in place. And if that gets kind of capped out, you have an umbrella policy to cover it. It's going to be a lot easier. Keep it simple, because half the time when all these people set up their LLCs, if they were actually get sued, they're not doing it right, and they're commingling assets, and basically the attorney and the judge is going to say, hey, you're not operating in business-like manner. LLC is defunct.
That's right.
And then all these years haven't been doing it right. Or like you said, the due on sale clause, it's in all the residential contracts. Yeah, I mean, that's all there. I mean, that I've never seen it happen, but
same here.
But the bank could call it, right?
Absolutely.
And there's no reason to open it unless you're sitting on a couple $1 million that if you got 10 properties that you could just pay cash for.
That's right.
Right. If the bank calls your note, most people are probably gonna be like, oh shit.
Yeah.
Like, what am I going to do?
Let me go retitle this. I mean, yeah, you're exactly correct. I mean, the idea of saving or protecting yourself, it seems a bit redundant from what they're trying to accomplish, because you're right. They are commingling what they're doing, whether their activity, their funds, that concept, and overcomplicating something that doesn't need to be that complicated.
And if you go to any of the guru conferences, right, they always have the attorneys in the back. Hey, for a few $1,000s, we'll set up your holding LLC, your operating LLC, your real estate LLCs. Yep. Oh, then we can set up a series LLC for you. By the way, it's $5,000. They're there to sell you the $5,000. That's all they want. You don't need to have all these different LLCs to, start and get into real estate. You may realize that, hey, my tenant keeps calling me at 5:00 on Friday night when I'm supposed to be out with the family. I don't want to do this anymore.
That's right.
Or, go get a property manager to do it for you. But at the end of the day, you may be like, I just don't want to do real estate anymore. Don't go set up all this headaches and compliance on the back end.
That's right.
Until you start getting bigger.
Now, prior to, and I don't know if it changed because of this, But prior to, and I was not in the lending world in this time frame, but 2008, 2009 crisis, the fraudulent activity that was going on, everybody and their mother and their dog apparently were getting mortgages. People were putting them in their LLCs. And when the finance company or the lien holder or the servicer of that loan goes to foreclose on something that's not being paid, it's a shell of a shell. That was, I hope, why they did it. Or change that, or did it ever even change from that? Because I know on our side, we used to accept that type of financing in an LLC. Now you have to go hard money if you want it that way and keep a loan on it.
Yeah, you can, or you just have to go to the banks, right? And so your bigger banks, not your, typically the best way to get loans, business loans, is through small local banks.
That's right.
Not your Wells Fargo's and Bank of America's.
Absolutely.
Because if you don't fit inside their little box that says you have to this, and this, and this,
right?
Like, oh, this is outside of that box, then they're like, we're not going to give you money.
That's right. And in many cases, it is up to the computer making the decision, whereas what you're advising is go to a bank that has a board, somebody that meets every week or so, that makes some decisions on people and their vision and what they're trying to accomplish and their business plan versus what was entered into a computer screen. And like you said, the red flags go, we can't give them that loan.
Well, it's even on individual mortgages, right? Go talk to...
You're right.
Because if you try to talk to those on the individual mortgages, if your credit score is not a 720 and you're making $200,000 a year,
God, so true.
And you're like, oh no, we're not going to get you a mortgage. Versus, y'all can find ways to help people get qualified and guide them through the process, right?
That's exactly right. And I think that is the most important thing about this little transition here is the guidance piece. Is no matter who you're working with, if you feel like they are just taking orders, chances are they are. And you need to be working with somebody that can guide you, that can advise you, that can give you their expertise, because essentially, is that not what you're paying for?
Exactly.
But yeah, let's see here. JC, how are we doing on time?
111.
111. Okay. Minus 15 for my little, okay. We're about an hour.
About 3 minutes.
Yeah.
We did.
Más o menos.
I'd say we're right around 106.
I like it. Brad, this has been an enlightening conversation. There's a lot of stuff that I learned within it, and I'm sure the listeners out there learned plenty. Most would go, wait a minute, you had a CPA on there? That's got to be a lame episode, but I guarantee you people are going to tune into this because most of the listeners are either looking for a CPA, dealing with a CPA, and most, if not all, don't know what the hell they're doing anyway, because they're there to sell real estate or they're there to run their business. They don't dream about tax stuff like you do. Yeah, right. So
we all dream, but some are nightmares.
Good point. Good point. That being the case, is there anything that you'd like to enlighten our viewers, listeners about regarding?
I'll try to give you the 90-second playbook on how to save the most money on taxes as a real estate investor. So you want to qualify for what's called rep status, and so that's real estate professional election on your tax return, and you have to document 750 hours of real estate and do that greater than anything. So you can't be like a job somewhere else, right? Mm-hmm. So as long as you're doing in real estate full time, which as a realtor is a great way to do it,
right?
So hopefully you're a very successful real estate agent. You're making a couple $100,000 a year. Take the profits, now go buy some kind of commercial or residential real estate. And when you buy that, go do a cost segregation study on it, which, you may put 20% down. And guess what? We can probably get you 30% deduction year one.
Wow.
So all your money you put in, you can basically get as a deduction year one on your taxes. And now you get that. So that reduces your tax. Basically, you can offset, since you have rep status, you can offset your passive income and your active income with your passive losses. Since we accelerated your depreciation, you can still make a couple $100,000, qualify for those mortgages, as a realtor. And now you have that properties and you're building your wealth through properties. And then on top of that, after you've done your cost segregation study, hopefully if you've got kids running around the home, get them employed in the business. And you want to make sure you're employing your kids through some kind of Schedule C, even if so part of your real estate business.
Right,
so you want to be a sole proprietor. Because if you can pay them W-2 wages, and as long as they make under the standard deduction, which is, we'll say, roughly $13,000 now,
Yeah.
you can, once they have earned income, you're not paying Social Security or Medicare tax if they're inside of your sole proprietorship business, because they were considered your dependent, and as long as they're under 18. And then from there, you can contribute to a Roth IRA. So now you can start building your kids up with Roth IRAs, and that'll be tax-free for the rest of their life. And it's better than like a college savings plan for 529 because say your kid doesn't want to go to college, right? They're just not ready to do it. Like we apparently weren't.
Absolutely. Absolutely.
And so with the 529 plan, you're stuck into college, right? But if you have a Roth plan, they can pull the money out to go buy their first home.
Yes.
There's all these other, you can always pull principal down, say they want to start a business, but you've got a business deduction for it throughout the years. Now your kids, right, have money that theirs is going to be tax-free forever.
Wow.
And so that's kind of the down and dirty of, how can we really do? And there's a lot more you can do into like,
I'm sure.
And everybody seen a TikTok video. Hey, I can, rent out my house and I can, to my LLC and then I can shift over the income, which you can. And all these kind of stuff we're talking about, there's right ways to do it and proper documentation has to be done. Mm-hmm. And what they're talking about is the Augusta Strategy, right? You can rent out your personal residence to your business for 14 days or less. And then that's a business deduction for you. So it lowers your taxes, and then you pick up the income on your individual tax return, but then you cite the code section on your Schedule E, and it basically wipes it out. And as long as you do less than 14 days a year. So it came from the Masters Golf Tournament, right? Augusta, Georgia.
Okay.
So they basically lobbied. So it gets back to, the tax laws, a set of rules on how not to pay tax. That's in the tax law, right? There's ways to do all this, but really gets down to documentation and record keeping.
Wow. If you didn't get anything out of the entire episode discussion, how about that last 3 minutes? Wow.
Damn, that was good. I'm going to go watch this video.
Exactly. So I'm impressed and grateful to be working with you personally. This last thing came up recently that I want to close out with just to make sure that everybody has right information. And it is initials acronym BIO. And it is this new requirement that business owners need to register in order to show their ownership of the business if it's more than 25%. Can you enlighten me on some of that? It came up in a group chat with a bunch of realtors, all of us business owners, and we were like, well, what the hell is this? I'll ask my CPA.
Yeah, so you've got the FinCEN, which is the Financial Crimes Division of the U.S. government, beneficial owner information report that everybody's supposed to file. But they had a Tuesday, it was either Tuesday or Wednesday.
Okay.
The National Federation of Independent Businesses actually won a court case in Texas that said, hey, this is unlawful against the Fourth Amendment. All the businesses should not have to do it. But it's really weird. So why this court case is ongoing, technically the deadline of 12/31 for all these businesses to register is still in effect. But then at the same time, the court said you don't have to do it. So basically the deadline's there, but you don't have to do it. So it's really weird.
Yeah.
It is where we're at on it. And so what we're recommending is basically to have all your information ready to file.
Sure.
But technically, since it's a pending litigation and the oncoming administration is typically more business friendly, they're probably not going to pursue it.
Right.
But at the end of the day, it was basically whenever you register your business at the state level, right? You say, hey, I'm Mark Jones. This is who I am. This is my address and that kind of stuff, right? Mm-hmm. They wanted you to start doing it on the federal side. Oh. And so they're trying, and it's for anti-money laundering and all this kind of stuff because all the, criminals are they've gotten a lot smarter throughout the years, right? And so they know, but if your business was large, you didn't have to do it. So they're like, hey, you're picking on small businesses. And so that's why they
basically... That does actually make sense as to why, because the first thing that makes me think of is monitoring people, which obviously we want to do that safely so that money laundering isn't going on, et cetera. Invasion of privacy. I don't really see it as an invasion at all, to be honest.
Public knowledge, but
I'm submitting my taxes anyway. You know what the hell's going on.
Well, I guess they don't really know who the owners are, right? Because sometimes you get layers of owners, and so they're trying to figure out who receives this money at the end of the day, who's the beneficial owner, right? Is where the name comes from. Yeah. And so the reason all this information lives at the state level, but since state and federal government separate, they're not allowed to talk to each other. That's why it's really confusing for like law enforcement and everybody else, is they're not allowed to talk to each other except in certain situations, right? Sure. And so in this situation, the state government cannot provide the information to the federal government, and so that's why this whole new thing. But yeah, the fees are outrageous, per day if you don't do it.
Per day. I saw it and I was like, I need to do this ASAP. And it's one of those things that I wouldn't mind doing regardless of this court case being overturned or not. I just don't want to get hit with those penalties. At the end of the day, I think it was $150 a day.
Right. And so,
What?
and how, of course, then you get into how are they going to enforce this? Like,
Yeah.
And so it's one
Levies.
one of those things. And so, yeah, you can go ahead and still file it. Like it's still out there. It's relatively easy. You basically say, hey, this is, my LLC. I'm the owner, and they need some kind of identifying document, just your driver's license or your passport or something like that. The problem is if you move, your driver's license expires, your passport expires, whatever identifying document you did, you have 30 days to notify them and refile it.
Oof.
And so that's
or it starts
or
that
it starts
penalty.
the penalties. I'm sure it'll be. I don't like if the court case gets overturned, then we'd have all this. We'll see what happens. It'll be interesting. We're keeping a watch on it.
Yeah,
So I mean, it's there but not there. Is I guess
that makes sense.
Obviously, but you can file it, and if you have multiple businesses and it does take effect, they have what's called a FinCEN ID.
Okay.
And so instead of you've got 10 different companies, right, you would have to go in each time your driver's license expired and update each 10 companies.
Right.
The way around that is to go get what's called the FinCEN ID, and then you only have to update once, and then it waterfalls down to all your other businesses.
Gotcha.
So
And
if you do want to file, you definitely still can. But if you have more than one business, make sure you fill out a FinCEN ID, and it's really easy. Probably take everybody 5 minutes. So I mean, everybody's doing it from like Gusto if they're your payroll provider for like $10 to attorneys for like $1,000.
Yeah.
To
click a couple buttons.
And so they have a PDF on their website you can download.
Yeah.
And it actually fact checks it and makes sure it's all filed correctly. And so like if I'm worried I'm not going to do it right, then you just submit the PDF.
Yeah.
And then it uploads it.
Well, tell you what, folks listening to this, I'm going to put a link to that in the description of this episode. So if you do feel like you would like to get ahead of this, regardless of which way the court case's outcome turns, you can go ahead and knock that out. Brad, this has been a awesome discussion. I'm not surprised at all. I know who I'm working with, and I'm appreciative of that. Anything else you want to let us know before we close this bad boy out?
Nope. Good to go. Semper Fi.
I love it, baby. Brad, thanks again. For those of you out there listening, I think one of the biggest key factors that I can give for you is coming from someone that did my own taxes for many, many years prior to finding a Brad. It is difficult. And what I found is that as smart and as long as I researched and used AI to help me when it was around back then, and as much as it could, Google search, you still miss plenty of opportunities, deductions, and savings that you could have had otherwise. Because let's face it, I'm in the game of lending money for mortgage loans, not doing taxes and keeping up with regulations and all the other things that go along with that. So a recommendation that I have for you is to find yourself a good CPA. I'm going to make sure that I've got Brad's contact information in the description of this. You can also visit BernieTXCPA.com to take a look at Dower and Associates. Him and his team have done a phenomenal job for myself and my wife and our businesses. That being the case, guys, hope you're getting something out of this. Make sure to like, subscribe, share with a friend. I'm sure this is one that you can share with a business owner that would be appreciative of you doing so. That being said, we will catch you on the next one.